we're going to be tackling the very concept of infinite banking from 5 increasing levels of difficulty. Now, the inspiration for this episode came from one of our clients who asked us if we could possibly make some content for her as she tried to explain some of these contents to, her children. And honestly, the concept of infinite banking is very large, it's very complex, and a lot of adults struggle to understand it. So it was a very high order, but I came up with something that I believe is going to be able, kind of no matter where you are at when it comes to understanding money and understanding the world around you, that you'll be able to pull something out of in order to kind of understand this at a deeper level. So the very first level that we're going to approach here today is level 1, and that is the level of a 7-year-old. And this is very near and dear to my heart because I have a 6-year-old at home, so I kind of know the way that kids of this age think and kind of what is important to them in life. And if you have a 7-year-old home, maybe it's going to look something like this, right? So this level is in the person with this kind of worldview, they're just starting to learn about money. And right now, though, money is very vague and it's difficult to understand. And it's also not nearly as cool as a giant puddle on the sidewalk that can be stomped in. But if I were to explain infinite banking to a 7-year-old, let's say, hey, have you ever brushed your teeth before? And hopefully they would say yes. And I said, well, great, because if you can understand something about toothpaste, then you can understand something about money. This is a bottle of toothpaste. And whenever you have a bottle that's full of toothpaste and you're going in to brush your teeth, odds are what happens is that you're going to squeeze out a lot more toothpaste than you need onto that toothbrush. If there was not a lot of toothpaste in the bottle, you're going to be a lot more stingy and you're going to only put a very little bit on the bottle because you don't want to run out on accident. That action is actually something called Parkinson's law. And Parkinson's law basically means is that whenever we have resources available, we're going to use them up. This is also going to be able to relate to money because it basically means that, the law says is that the time expands to meet whatever time you have allotted to do your activity in. And it can relate to money in the same way to say is that, whatever money that you carry around, if you have $10, you're going to find a way to spend the $10. And so there's a lot of adults that actually get trapped by this law. And whenever money comes into their life, it immediately comes out of their life. And so in order to get out of this, we don't just need a piggy bank, we need a magic piggy bank. This is going to be my stand-in for a magic piggy bank. I was not able to get one on Amazon quite fast enough for this video, but imagine this is a magic piggy bank. Let's say, once again, you're a 7-year-old. So, you do some chores, you do some things, you work around the neighborhood, you make some money. If you want to save the money, you're going to have to put it into your magic piggy bank like this. Now, let's say that once again, you're a 7-year-old and there's things that you want like toys. How are you going to afford this toy? Well, normally the way you would have to do it is you would have to go to your piggy bank. You would have to pull out your money. You would buy the toy, except after you buy the toy, there's no money and there's nothing left in your piggy bank. It's totally empty. And so that's one way in order to get what you want. But there's another way to get what you want, which is where instead of you spending your hard-earned money to buy the toy, you put your $10 in the magic piggy bank. And let's say then you go back to this bank and you say, hey, I want to buy the toy. They say, okay, keep your dollars here. Just keep your money. Here is $10 more. Go buy that toy. Just promise to give us it back. In this way, you've now spent the bank's money, but your $10 is still here and you have your toy. And this is key. You've promised to pay the bank back. So now you're going to have to work hard in order to pay the bank back in a timely fashion. So that's level 1 of understanding. So now we're going to go up to level 2. We're going up from a 7-year-old to a 16-year-old. Now, there's going to be quite a lot of developmental changes that have happened since this point. There's also maybe been a little bit more experience in the workforce. Likely, I don't know your experience, mine, I definitely saved up for my first car. This is kind of right around that time. So you've had some significant experience both making and spending money. And now you're ready to buy your first car. So you're 16, you're ready to buy your first car, and you kind of have two options. You can either spend the cash that it took you a really long time to make, or you can get a loan from the bank. If you get a loan from the bank, you're going to have to pay the loan back with interest. And you're doing that because you are paying the bank for the privilege of using their money. I can kind of hear what some of you are thinking is that if you're 16 years old, why wouldn't you pay for cash with something if you can buy it and then not have to pay any interest? It's a very fair question. To answer that, I'm going to tell you a story about a grocery store. Imagine for a second that you own a grocery store. Let's say that you have this can of peas And this can cost 57 cents to buy, and you sell it for 60 cents wholesale, right? So 60 cents, the 3-cent spread pays for your lights, it pays for your salary. This is how you stay in business. Now, let's also say, since you're human, that you get hungry and that one night you want to have dinner and you want to include peas. Now, how do you get peas? You have 2 ways that you can get the peas. So the first way that you can get peas is that you can say, you know what? This is my grocery store. I bought those peas as a store. I'm just going to grab the peas and walk out the back door. That's choice A. Now, choice B, instead of walking out the back door, you take this can of peas up to the register, you pay for it, and you walk out the front door just like every other customer. What is going to lead to, what outcome? So with choice A, getting the can of peas this way, you're effectively stealing from your own business. And just doing that one time, in order to get back to even, you're going to have to charge every single customer a higher price to make up for that one can that you stole. Or if you do this enough times without making it up, you'll eventually go bankrupt because you're stealing from yourself. Now, choice B, you bought it just like every other customer. Your business stays healthy. And because you own the business, eventually the profit will come back to you. So 2 different choices. Choice A, steal from yourself. Choice B, respect the bank. And that's effectively what you're doing with infinite banking. With infinite banking, the way this works is that you're essentially using your life insurance policy and you're treating that like the bank. If you're in the situation where you're buying your car, you're using your life insurance policy and you're borrowing against it and paying the policy loan interest in order to keep the money inside your policy. Once again, difficult to understand when, we usually think of interest as a bad thing. But once again, you have to think of your ability to save like a bank. And if you are a bank, don't steal the peas. Now we're going to upgrade to level 3. Level 3 is what we're going to call a sophomore level college student. When you're explaining these kind of the infinite banking concept to a college student, you can graduate quite a bit because this person's probably at a level of complexity that they can kind of understand some of the intangibles. They understand a little bit more about the way that money works, what certain strategies might be versus other strategies. And clearly they've already displayed some kind of interest in finance, right? So I kind of picked the sophomore level finance major, but this is a person who's comfortable talking about some of the intangibles of finance. Now, if you were to talk to this person, I'd say that, hey, you'd start telling them about infinite banking and, maybe they would say something like, why go through all the trouble of setting up a life insurance policy when, I can just put my cash in a high yield savings account, right? It's totally liquid, 0 interest, 0 hassle. And I would respond, to this person, like, I love your mindset there. I love how, you're kind of focusing on liquidity, and liquidity is really important. But, I'd have 2 main reasons why it's worth all the hassle. And the first reason is risk. And I'd say, you just started studying a lot in college, and you might have heard of something called fractional reserve banking. And fractional reserve banking is how your bank basically just hangs on to, let's say, 10% of the dollars that you put in, and it lends out the other 90%. This works all fine and dandy until everyone wants their money back at the same time. Fractional reserve banking is that kind of what essentially it created the basis for what would become the financial collapse of '08. It gave the banks the ability to kind of get in way over their heads and become way overextended when it comes to subprime mortgages. Essentially, it was kind of a faulty sort of premise and a faulty system that allowed that collapse to take place. And ultimately, you have to ask yourself, how much faith do you have in the US banking system? It's essentially the federal government's promise that, that they're going to back that bank if something really goes south. Now, with infinite banking, the crazy thing about this is that this is in a life insurance policy. So fractional reserve banking, is not a concern here. It's actually, as part of your contract, the insurance carrier is obligated to have a dollar for dollar reserve of liquid capital for every dollar of cash value that is held by the policy owners. And so it's not a leveraged gamble, it's a contract. So risk, first reason. Number 2, the math. So 2 propositions that are worth exploring. So the first proposition, the one that honestly broke my brain and kind of convinced me of the importance of this, is the proposition that you finance every purchase that you make. And the second proposition is that rate of interest can sometimes distract from volume of interest. And so let's take a look at the first one here, is that you finance every purchase you make. To the sophomore level, college student, is that when you are considering financing a purchase, so let's say, think back to when you were 16 and you were buying your car, you had two choices, is that you could either purchase the car with cash, or you could finance the purchase of the car through a bank loan. And one way, if you purchase through cash, ultimately you don't pay any interest to the bank, but you are going to miss out on the interest that those dollars could have earned you for the rest of your life. Or option B, you keep those dollars, you keep them liquid, and you say that they can still work for you, and you promise the bank that you're going to pay them back interest on this car loan over the course of 5 years. And so when you choose to pay in cash versus borrow against it and pay the bank money, is you're interrupting the compounding curve of your capital. Whereas if you go to the bank, get the loan, is that you're not interrupting that curve. And life insurance is essentially, if you were to get a life insurance policy and go through the hassle of getting that, you would be able to keep the money inside your policy, which is earning dividends, which is going to result in an above average rate of return on those dollars without sacrificing very much liquidity at all. And you don't interrupt the compounding curve of your capital. Whereas if you don't do that and you just pay out those dollars, you're going to interrupt that compounding curve. So that's the first proposition. Proposition number two is that rate of interest can sometimes distract from volume of interest. Now, this is a really interesting one. And Nelson Nash did a great job of kind of explaining why this is an issue, is that sometimes people look at maybe a 5% rate of return, and they might be like, oh man, if I could only get that up to 7 or maybe even 10%, that'd just solve all my problems. When they're missing out on the fact that they're actually paying 35% of their total income to interest as a volume. So Nelson Nash said that you can't solve a 5% rate of return problem with a 35% volume problem, right? Is that that the math doesn't math in that circumstance. So sometimes with people who just think that I just need to get a better rate of return, actually something that, and that's not to say that it is a bad idea. It is good to get a better rate of return, but we also need to be aware of the total volume of interest that we're paying out to other places, be it our mortgage, be it our car loan, or whatever. And infinite banking is about trying to recapture some of that 35% back into our own economy. Now, those numbers that I used earlier, the 5% interest and the 35% volume of interest. Now, 5%, I just kind of made up, but 35% is what the average American pays out of their total income in interest on existing loans. And so sometimes no matter what kind of rate of return you're thinking about, if it's anything south of 35%, the total volume of interest is also worth thinking about as well. So two reasons I would tell it to the sophomore age college student is that one, it's the risk. Remember that it's not a leveraged gamble in life insurance. It's a contract. It's safer than the fractional reserve banking that has been happening up until now. And then two, it's the math, is that you finance every purchase you make. You don't want to interrupt the compounding curve of your capital. And two, that is that don't let rate of return distract from the volume of interest. We're going to the next level. It's level 4. So now we've graduated from a sophomore level college student to somebody who's a financial advisor in training. Maybe they're a PhD student or something like that. They're a PhD candidate. So they have a very extensive knowledge of finance. And maybe they haven't done a lot of specific research into infinite banking or life insurance, but they know their way around very well, and they can understand kind of maybe some of the value of the asset class. Now, when you're talking with somebody of this level, definitely come prepared. All right. And so let's say you are engaging in a conversation with somebody like this. And this is somebody who's very advanced, somebody who knows their way around talking about lots of different kinds of things. And this is just maybe one thing that they're maybe just a little bit less familiar with, but they still definitely know their way around. So having a conversation with them, maybe they've even seen a life insurance policy, and they'd say, oh my gosh, this returns, and looking at the cash value of the policy, which is the amount that you can access, this returns 2% after 30 years. This is a terrible investment. And to them, I'd say, you're right. And a standard whole life insurance policy is a really bad investment. If it is created for death benefit and not for cash value accumulation, then yeah, it probably would be a really bad choice of a liquid savings tool for maybe use of supplemental retirement income, because once again, those are just two different policies created for two different reasons. Now, if this asset class is so bad though, why would banks love it so much? And so if you've ever heard of bank-owned life insurance, right, is that this is a tier 1 asset class. It's liquid, it's stable, it's efficient, it's really, really good. And the way that we can build, maybe not on a level for an entire bank, but for an individual person, that we can build this really efficient, very liquid savings tool style policy is we built it to be something called overfunded. And an overfunded style policy is basically created by minimizing the amount of commissions that agents get for writing them, and it's maximizing the amount of value that you get while you're still alive. So there's the death benefit of the policy, and we're shrinking that. And we are instead maximizing the living benefits of the policy. And the living benefits of the policy is what's called the cash value. It's a portion of the death benefit that you get to use before you die. And we do this all by essentially playing right underneath the MEC limit. And the MEC limit is like the line that the IRS is like they're playing referee here, and they're deciding what counts as life insurance and what counts as a modified endowment contract. And so we build it to be just underneath that line, that it is, if you fund it all the way up to the limit, that it's going to earn this kind of above average rate of return, kind of like a tax advantage high yield savings account. But once again, it's tax advantage as opposed to high yield savings accounts, which are not tax advantaged. And you can use it while you're still alive by borrowing against it. Now, doing it this way, obviously you need to find an agent that knows their way around and kind of knows what you're looking for, because not every agent is actually kind of, into this field and actually kind of knows what's going on. And maybe you'd even be able to show this person a kind of an overfunded illustration. And now maybe this person would kind of look at one and look back and say, okay, so this one is definitely different, but come on, man. The IRR of this policy is, 5%, over 30 years instead of 2%, whoop-de-doo, the S&P 500 averages 10%. Like, why would you have such a low yield asset? I would actually point them back to, okay, so the IRR is, as maybe you might have just thought that is kind of equivalent to saying rate of return, but it's not, is that the internal rate of return is not just a rate of return, but it's saying, like, if you took a point right now and looked at a point in the future, is what you would have to get every single year without a single down year in order to get from this point to that point. And this is kind of what blew my mind thinking about infinite banking, is that, like, rate of return, if I have $100 and then next year there's 100% rate of return on my money, I'm going to have $200. And then the next year, let's say that there is a 50% loss, is that I go from then 200 back to 100. And so you'd think that, like, oh man, like, you did great because you had 100% gain one year, but realistically you went from year one of having $100 to year three of having $100. You had $0. Like, you didn't make any changes, except that your rate of return year over year would have been 25%, because you take 100% and then you add a negative 50% to it, divided by 2, and then you get to 25%. So once again, rate of return is, like, as a simplified sort of metric, is not like a good apples to apples with IRR. Now, it's also important that, like, this IRR is a taxable equivalent yield, where it's like, it's not really fair to take a product that might have, like, yes, maybe the rate of return that you get in the S&P is like 10 to 13%, but that's a taxable 10 to 13%, whereas the IRR for life insurance is not going to have taxes assessed on it in the same way. So it's not really a fair comparison. Now, lastly, after we talk about kind of the whole averages and looking at, like, how 5% over a 5% IRR, and it's a tax advantage 5%, is actually pretty good over 30 years. Another thing you want to take into account is the sequence of returns risk, is that if you get to the point where you're thinking about distribution, it's great to, if there is a down year in the market, to take, instead of liquidating a depreciating asset and compounding your losses, to liquidate an appreciating asset that is contractually obligated to always appreciate, and to give your volatile assets time to recover. Because if you liquidate your depreciating asset, like your volatile assets, like your stocks, you're going to enter what's called a loss spiral. And essentially, you're going to have to sell at a steeper loss in order to maintain your standard of living, which you want to have in retirement. So this policy kind of acts like a volatility buffer, is that, it's great for you to be able to use maybe 1 out of every 4 years if there's a down year in the stock market when you're in retirement. You can essentially take from this policy rather than liquidate a depreciating asset like your stocks. So that's level 4 of a conversation on infinite banking.
If you're a high-earning professional, entrepreneur, or just somebody who wants more control of their money, we offer something called a clarity call. It's a one-on-one conversation where we look at whether or not overfunded whole life insurance could help you build a safe, liquid, and tax-advantaged foundation to help you grow your wealth. Now, there's no pressure or fluff. We're just looking to get real clarity on whether or not this strategy aligns with your goals. So click the link in the description below or hit the tag comment. And now we'll go back to the video.
Congratulations, you have progressed all the way to level 5. This is the highest level at which you can reasonably expect to talk about infinite banking with another human being. So pat yourself on the back. Now, what does a level 5 conversation sound like? And this is where you're talking to a fellow expert. And so let's just assume for sake of illustration that this fellow expert is a wealth coach here at Better Wealth. Well, first off, you're going to have a lot of jargon. And there's going to be a lot of technical phrases that you throw around. And unlike previous levels where you've kind of scaffolded those people up to those levels, is that you're going to probably just feel comfortable using these terms directly with whoever is working with you and without having to kind of identify what that means or kind of define terms. So lots of jargon, and you're also going to be very excited because you both, you love talking about this stuff, and this stuff kind of really gets you fired up. Now, when you're having these conversations, kind of two things come into play. Is first, you have a lot of experience with infinite banking. You've read Nelson Nash's book. You get the savings strategy. And two, you've seen a lot of life insurance policies already. You don't need to have somebody tell you what each of the different columns mean because you've already seen enough of these columns to know what they mean on your own. And most importantly, you understand the ways that these two work together, is that the infinite banking savings strategy is best expressed through a participating mutual life insurance carrier, and they complement each other long term. So this conversation, this level 5 conversation, is going to kind of bring those ideas together. And so here's what this would look like. So let's imagine that you book a clarity call and somebody on the team kind of calls you at that appointed time and you just launch right into it. And you tell them, hey, I'm looking for a high early cash value policy. And that's great because probably if that's what you come in wanting, is that you're wanting a lot of liquidity in the first year. Now, this is similar elsewhere in the finance space to maybe like the J curve of private equities, where there's less money contributed present, at least in the policy, than was initially contributed, but over time is going to hopefully exceed the cost basis. Now, as an agent, the way that I'm able to work this is I can basically take your policy and I can structure the premiums so that about 80% of your premiums are going to paid up additions and about maybe 20% of your premiums are going to base plus term insurance. Now, doing that is going to provide you a lot extra liquidity, and it's going to shrink the amount of commission that the agent gets for writing your policy. Doing it like this and doing it with the right carriers, you can actually maybe even get a break-even policy in year 4 or 5, depending on age or health rating. In terms of growing the size of your policy, this is what we referred to in past segments as the IRR, or the internal rate of return, is that's going to be most accomplished by 2 different things. It's the amount of premium that you contribute, and then 2, it's the dividends that are going to get paid into your policy and reinvested into it. And the dividend growth is really determined by about 5 different factors. It is the total investment returns of the carrier. It's the amount of premium that you can contribute. It's the expense management of the carrier. It's also the mortality experience of the carrier and your policy persistency, right? All 5 of those things are going to be a factor in the amount of dividends you receive. And those 2 things, amount of premium you contribute plus the dividends you get, are going to be the largest factors in what is ultimately growing your policy. Now, a lot of people will learn about the IRR of a life insurance policy and they might just scoff and think, oh my gosh, what a terrible investment. And, I could do so much better than that if I got real estate or stocks, and this is just a waste of time. But when we're having a level 5 conversation about life insurance and about infinite banking, we're going to stop making comparisons to volatile assets like real estate and stocks, because that's a bad comparison. A much more fair comparison, better comparison, is to another safe asset bucket, specifically bonds. And when it comes to bonds, experts know that bonds kind of have a fatal flaw. And that's because bonds have an inverse relationship to interest rates. And that is, when interest rates go up, the prices of bonds, and the value, I should say, of bonds go down. And any existing bonds that you had held as your portfolio are going to essentially lose value, right, when you need them the most. And this is a problem. Now, participating whole life is the opposite, right? It has a positive correlation to interest rates. Interest rates rise. Carriers are going to invest new premiums of your new premium dollars at higher yields, which is going to result in this tailwind for future dividends. And this is going to essentially supercharge the performance of your policy over time. So by swapping bonds for whole life, what you're doing is you're getting an asset that crashes when rates fall for one that gets stronger for when they rise. And talking about interest rates here. Now, you're essentially improving the Sharpe ratio of your life. The Sharpe ratio is basically you're getting the same returns with 0 volatility. And that's great. Basically, you're taking your safe chest, your safe asset bucket, and you're turning it into this opportunistic war chest that you can use for, whenever anything else is on fire. And this basically brings back to mind the story of the First Midland Bank of Texas in 1983. And at the time of its failure, it was the second largest bank failure in US history. In 1983, at the time, everyone was blaming it on the oil bust, except after time went on, they did an investigation. They actually realized that wasn't the fault. It was actually insider lending. Is that the members of the board of directors were actually lending themselves money for essentially bad investments. Whenever they called for the loans, they weren't able to pay the loans back, and then everything fell. And if you remember back to a previous level when we were talking about it, effectively, they were walking out the back door with the peas, right? They treated the vault like their personal piggy bank, and they didn't capitalize their own banking system. And when the stress test came, it all collapsed. So just to wrap up a level 5 conversation, the premise is simple, right? The product is reliable. The strategy is perfect. The math is sound. Lastly, though, actuarially, it's fine. But if you don't treat your bank with respect, your bank's not going to survive. That is infinite banking in 5 levels, explained at varying levels of difficulty. If you made it all the way to the end of the video, congratulations. Very proud of you. This is a video that you're probably going to want to watch back a couple times, or maybe you're going to even want to talk to somebody on the team at whatever level that you're currently at in order to understand this more, or maybe even pursue looking at what a policy would look like for you. And anybody on the team is going to be happy to do that. Thank you so much for watching. Appreciate you. Tune in next time. Bye-bye.